Warren Buffett has maintained a 30% return on investment per year for decades, and he thinks you can do it too. Buffett, the Oracle of Omaha, plays his cards differently, and you'd be shocked at some of his philosophies for investing. Today, I'll present to you Warren Buffett's proven strategies that'll help you achieve 30% return per year. Watch till the end because you don't want to miss a single step. Before we begin, be sure to hit the subscribe. So let's get started. Now, what makes Warren Buffett stand out in the game of money and investing? Warren Buffett was born in Omaha, Nebraska in 1930. He was the second of three children, and his father was a stockbroker and a member of Congress. Buffett showed an early interest in finance and investing and began his first business at the age of 11, delivering newspapers. At that age, he bought his first stock. By the time he graduated in high school, he had already become a profitable investor in the stock market. Buffett's incredible success as an investor is a testament to the power of passion and dedication. From a young age, Buffett pursued his interest in investing with tenacity and commitment that set him apart from his peers. So, what's the secret to becoming a successful investor according to Warren Buffett? Number 1, buy and hold. You see, Buffett's investment philosophy is based on the concept of value investing, which involves buying undervalued stocks with strong fundamentals and holding onto them for a long term. I like to think of business fundamentals as things such as solid business model, a competitive advantage, and a track record of profitability. Buffett has been able to consistently outperform the market and achieve remarkable returns over several decades by focusing on the intrinsic value of companies rather than short-term market fluctuations. Buffett is also known for his buy and hold strategy, which involves investing in companies for the long term and not worrying about short-term market fluctuations. He's famous for saying, "Our favorite holding period is forever." Number 2, calculating risk. Warren's success also highlights the importance of taking on calculated risk. Although he started investing at a young age, Buffett was careful and deliberate in his investments, always conducting thorough research and analysis before making a decision. This allowed him to mitigate risk and paid off in the long run, rather than relying on luck or intuition. But what makes Buffett's strategy so successful? Number 1, invest in what you know. You see, Buffett has consistently invested in companies that he understands and knows their industry. For example, he invested in American Express in the 1960s when the company was facing financial difficulties. He recognized that the company had a strong brand and customer base and saw the potential for long-term growth. He held onto the stock for several decades and saw significant returns as the company's share price increased. Number 2, value investing. Buffett's investment philosophy is grounded in value investing, which involves buying undervalued stocks with strong metrics and solid long-term growth prospects. We can take, for example, in the late 1980s when Buffett invested in Coca-Cola when the stock was undervalued because of concerns about the company's future growth prospects. However, Buffett recognized the enduring popularity of Coca-Cola itself as a brand and believed that the company's strong management team would continue to drive growth. You may have noticed that this investment has since paid off handsomely, with the stock rising more than 10 times its original value. Number 3, long-term focus. Now, the power of compounding is a fundamental principle of investing that has been proven time and time again by successful investors like Warren Buffett. When you invest your money and earn returns, those returns are reinvested back into your investment, allowing your money to grow and grow exponentially over time. For example, imagine that you invested $10,000 in a stock that returned 30% annually. After the first year, your investment would be worth $13,000. But instead of taking your profits and running, you decide to reinvest your returns and keep your money in the stock. At the end of the second year, your investment would be worth $16,900, and after 3 years, it would be worth $21,970. As time goes on, the returns on your investment continue to compound, leading to exponential growth in your wealth. Number 4, margin of safety. Buffett emphasizes the importance of having a margin of safety in any investment. This refers to the ideal that an investor should always look for investments that offer a significant margin of safety, meaning that the potential downside risk is limited, while the potential upside is substantial. One example of this is his investment in the Goldman Sachs during the financial crisis in 2008. At the time, the financial industry was in turmoil and companies were struggling to stay afloat. However, Buffett saw an opportunity in Goldman Sachs, which had a strong balance sheet and a proven track record of success. Buffett was able to limit his downside risk while maximizing his potential upside by investing in Goldman Sachs with a margin of safety. This meant that Even if the stock price continued to decline in the short term, he was confident that the company's long-term prospects would eventually lead to a significant return on his investment. Number 5. Patience. Buffett's patience has allowed him to avoid short-term thinking and focus on the long-term success of his investments. For example, he invested in Amazon in 2019 after years of watching the company's growth and success. He recognized that the company had a strong competitive advantage in the e-commerce industry and saw its potential for long-term growth right there and then. He held onto the stock for several years and saw significant returns as the company's share price increased. For example, in 2019, instead of making a quick profit by buying and selling Amazon shares in the short term, Buffett chose to hold on to his investment, allowing it to grow over time. This patience paid off as Amazon's stock price continued to increase, providing significant returns for his investment. Number 6. Diversification. Warren Buffett understands that no investment is entirely risk-free, and by diversifying his portfolio, he can reduce the impact of any single investment on his overall returns. Buffett's approach to diversification is not simply about spreading investments across different industries and sectors. Instead, he carefully selects his investments based on their individual merits and looks for companies with strong competitive advantages and long-term growth potential. For example, in the finance industry, Buffett's Berkshire Hathaway has invested in several large banks, including Bank of America and Wells Fargo. In the technology sector, he has invested in companies like Apple and IBM. In the consumer goods industry, he has invested in companies like Coca-Cola and Procter & Gamble. By diversifying his portfolio across these different industries and sectors, Buffett can reduce his exposure to any one company or industry. If one investment performs poorly, it will have less impact on his overall returns because he has other investments in different industries that can offset any losses. Remember that Warren Buffett's investing rules are not a magic formula for overnight success. Achieving a 30% return per year will take a great deal of knowledge, research, and patience. However, by understanding Warren Buffett's investment philosophy and applying his principles to your investments, you can potentially achieve significant returns over the long term too. So take the time to learn from the Oracle of Omaha and start building your wealth today. Please leave a like and subscribe if you found this video helpful. Thanks for watching. See you in the next one.